Hello, I'm Kamal Santamaria. This is Counting the Cost on Al Jazeera, your weekly look at the world of business and finance. This week, China in Africa. Can there be profit without the politics? Can China maintain its economic interests on the continent despite the regional tensions? Also the euro and why any breakup is a bad idea. We get the thoughts of Paul Donovan, global economist at UBS. Plus the country which rode out the financial crisis better than most, but now is getting the blowback from a commodities boom. We explore Canada's growing debt problems.
And I'm Joanna Gajrowska in Istanbul, where a strong economy is helping Turkey become one of the frontrunners to secure the 2020 Olympics.
Hello everyone, nice to be back with you, and thanks to Matt Moore for filling in on last week's show. This week we are taking a good look at China and its relationship with Africa, the short story being one of a country big on investment but reluctant on politics. But in a place like Sudan, oil, money and politics, they're all pretty difficult to separate actually. Just ask the Chinese. In fact, last year they were buying 260,000 barrels of crude from the entire country every day. But then the south broke away and left those unclear borders and a dangerous split of the oil resources. For example, South Sudan ended up with 75% of the oil, which is roughly 500,000 barrels a day. The danger is, though, that accounts for 98% of the country's income, all of which has to run through pipelines to the north in Sudan. So you've got a regional split plus an international player with big investments. Can China protect those investments, maybe even through diplomacy? Peter Grester takes a look at that.
This is South Sudan's jugular vein. The road that joins the capital Juba with Uganda to the south is the only stretch of paved highway in the entire country. Along it flows food, building materials, fuel, everything the fledgling nation needs to survive. In a country as undeveloped as South Sudan, infrastructure is the essential area of development, which is why China has agreed to lend this country $8 billion for development of infrastructure like roads, bridges, telecommunications and the like. But it's also given China enormous political clout. South Sudan's President Salva Kiir signed the deal in Beijing last week. China has been famously reluctant to get involved in conflicts like the one between Khartoum and Juba, preferring to focus on business over diplomacy. But this dispute is different. China's biggest money is in oil, a resource that straddles the border.
Even if we were to trade with Khartoum, we are basically trading with the resource that China is deeply involved in. So I'm sure they can have leverage on Khartoum. They are the only country that can have leverage. Not even United States have leverage on Sudan or Soviet Union or France.
Both Sudans depend on oil so deeply that neither can pay their bills without it. That includes their debts to China. But the only pipelines from the south run through the north, tying the two countries together in an uncomfortable interdependence. South Sudan had hoped China would help fund a new pipeline to escape Khartoum's chokehold on its oil. Beijing declined.
The fact that China wants to be seen to balance its relations between the two countries equally, and the fact that the pipeline may take 3 to 4 years to construct, China's likely to, in the short term, to focus on encouraging both sides to end hostilities and return to the negotiating table.
So the very thing that Sudan and South Sudan have been fighting over may well be what brings them back to talks. And as both countries' biggest investor, China has the most to lose, but also the biggest influence.
So how best to balance that? We've got a real expert to talk us through the ins and outs. Ambassador David Shin, a professor of international affairs at George Washington University, also former US ambassador to both Ethiopia and to Burkina Faso. So thank you very much, Ambassador, for joining us. Pleasure to have you with us. China famously stays out of politics. We know that. We see it at places like the United Nations quite regularly. So really, no surprise that it is choosing to stay out of this Khartoum-Juba Sudan, South Sudan dispute, even though it has all these business interests there.
You're right, it does try to stay out of politics, but I think increasingly China is finding that as it has become a major power, it is almost forced into politics, and Sudan is a classic case in point. It did get involved to some extent in the Darfur controversy, and it is getting far more involved politically in the current conflict between Sudan and South Sudan. So whether it likes it or not, it perforce is being required to become more active on the political side of things.
Yeah, but is it still managing to look after its own interests, not get so involved that it puts those investments at risk, if you know what I mean? This is the whole point of what we're actually talking about here, the fact that China is probably the most important player in Sudan, most important player in Africa.
In the case of Sudan, I would say yes, so far it has been able to preserve its interests, although it's walking a very fine line. It is obviously the single most important foreign power involved in the oil sector in both Sudan and in South Sudan. It also is the single largest investor in both Sudan and South Sudan, and it clearly wants to keep its investments in order in both of those countries. But it would like to see an end to the dispute between the two countries because the oil has effectively stopped flowing. So it's in a very delicate position at the moment. If you look more broadly at Africa, I think that it also has, for the most part, preserved its interests pretty much throughout the continent, its economic interests throughout the continent.
So oil is so important, and yet China chose not to get involved in the building of an oil pipeline. We saw this briefly in that report from Peter Grester. All the oil actually has to go through the north, or Sudan as we should call it. And yet the idea of building a new pipeline out through the south was rejected by China, or at least they said, no, we're not going to get ourselves involved. That would have surely been in their interests.
Well, one would think so, and I think the information on that may be conflicting. There's earlier information suggesting that China was at least in discussion with the South Sudanese government about constructing a pipeline. Now, maybe they have changed their mind on that issue, but China did offer, when South Sudan President Salva Kiir was recently in Beijing, some $8 billion in development assistance. I assume that would all be loan money. And you know, $8 billion will get you an awful lot of infrastructure. And whether they had a pipeline in mind with that money, I don't know. But I'm not sure that that part of the question is closed.
What sort of risks, Ambassador, if we flip this around, because we're sort of looking at this from China's viewpoint so far, what sort of risks are Sudan and South Sudan running by having such a high level of Chinese investment? Is it, or is there a risk at least of sort of too many eggs in one basket?
There is, if indeed you do rely almost exclusively on Chinese investment or engagement, and that is something that South Sudan is going to have to work very hard to avoid. Now, there are other countries investing or thinking of investing in South Sudan, including some American companies in the agricultural sector, some Saudi companies in the agricultural sector. So it's not as though South Sudan is thinking of putting all of its eggs in the Chinese basket, but certainly no one has come up with a figure of anywhere close to $8 billion worth of investment, as China recently suggested.
Yeah, but then if you start involving those other countries, getting them investing, does that create a new conflict or a new risk in that, well, China's already there, an American company might be less interested as a result, or the United States might want China to use its influence for something else if it comes in there. Do you create a little regional struggle almost within another country?
I don't see that as a major problem. I think there's plenty of room for many countries to invest not only in South Sudan and Sudan for that matter, but throughout the continent. So there's lots of room there for numerous countries to expand their engagement. And I think the problem of late has been that it's only a handful of the emerging countries like China, India, Brazil, that have been putting significant amounts of money, new money, into Africa. And it's time that the Western countries, some of the traditional donors and investors in Africa, return and re-engage, because I think there's money to be made in Africa.
In the end, do you think China's on the right track here, the way it's playing all of this? You said at the start of this interview that China's having to involve itself more politically, it's got to get its hands a bit dirty a little more. I guess I'm asking you to crystal ball gaze here and to see how you actually think this will play out in the future.
I think that up to this point, China has played its Africa card quite well. I think, however, they are getting into territory that is trickier and trickier as they have expanded their interests on the continent And as the issues become more difficult and complex, and China does not have the best understanding of developments in Africa, they're still in the learning mode. And as time goes on, I think they're going to find it more difficult, and they're going to find that they face a lot of the same kinds of difficult issues that Western countries have faced. And as a result, they're going to have to get more engaged than perhaps they would like to get engaged on the political side.
All right, Ambassador David Shin, they're very interesting talking to you today. Thank you so much for your time.
Thank you very much.
And still ahead on Counting the Cost, money talks. Why the motto, faster, higher, stronger, doesn't necessarily cut it if you want to be an Olympic host. But has Turkey got the goods? We'll explore that a little bit later. Now here's a familiar story, and we probably know how it ends too. Canadians are being told by their government to borrow less money as household debt climbs to near record levels. It's a bit of a blow for the Canadian economy, which weathered the financial crisis better than most, but now has to deal with rising debt and an overheated housing market. More from Daniel Lack now in Toronto.
Think of Annick Pelletier as typical of many Canadians these days. A good income helped her buy a home and enjoy life in her country's largest city. Restaurants, entertainment, shopping, especially shopping. Before long, she owed tens of thousands of dollars, much of it high-interest credit card debt. When freelance work that helped pay the bills dried up, she faced a stark choice.
When you're on your own, you have to rely on yourself, and you have to have all that accounted for. And unfortunately for me, I had to make drastic decisions, and one of the decisions is to, sell a house and, and pay my debt with that.
Okay, so this represents, a few clients basically will come in to see us. And
at a leading credit counseling service, they're seeing more and more people in trouble, as Annick was. But unlike her, most debtors can't just unload a house or a large asset. And even worse, they haven't got much money put aside for that proverbial rainy day.
Many Canadians are literally one paycheck away from financial disaster. And what that means is they have no cushion, no emergency fund. So with the debt that they're carrying today, and if there's a job loss for them or some emergency that happens to them, it's going to be very hard for them to sustain their full financial situation.
Canada's consumer debt levels approached an all-time high earlier this year, and they already surpassed those in the U.S. Government debts are also growing. This country emerged from the subprime mortgage crisis better off than most. Now economic planners think it's time to concentrate on the fundamentals.
I think we're reaching a concerning level. I don't believe the level of household debt is necessarily a clear and present danger to the economy. I think it's more an issue that suggests that there really isn't a lot of room for the Canadian consumer to grow faster than the economy in the years ahead.
The latest figures suggest consumers have begun borrowing at a slightly less frantic rate. Slightly. People are still using their credit cards, but more cautiously and less often.
So Canadians seem to be paying heed to their government and running up less new debt than before. But concerns remain, not least about a real estate and housing market that could slow down and cast a pall over the country's financial health.
Toronto is now North America's condo capital. More condominiums are being built than in New York or Chicago, and there are still more buyers than sellers. It's the same with houses. Mortgage rates are low, and many Canadians are sinking more and more money into their homes at a time when global economic recovery remains uncertain.
If we actually had another recession in this country, perhaps driven by a debt crisis in Europe or a renewed downturn in the U.S., and then we saw job losses here in Canada, that's what would really concern me about the outlook for the housing market.
Canadian governments are paying down debt themselves and urging consumers to follow suit. They're keeping a wary eye on the housing market and on conditions abroad. Challenges lie ahead, and it's far from clear how the country will weather them this time.
We're on Eurowatch again this week because, frankly, things still aren't really improving. But while the zone and the currency aren't perfect, the cost of any breakout would be unimaginable. We're talking a worst-case scenario of civil unrest and the imposition of authoritarian governments. At least that is all the view of the Swiss bank UBS, whose global economist Paul Donovan dropped by the studio earlier in the week. We began by chatting about the Eurozone's current hotspot, Spain.
There's a problem. there is a problem with Spain's debt structure. It's very short maturity. And what that means is Spain keeps having to go back to the market and saying, can you give us another loan, give us another loan, give us another loan? And the market at the moment is inclined to say, actually, we'd really rather not keep on lending you this money.
Fair enough as well, then.
Well, indeed. And then we've got the second problem, which is the banks. Now, the Spanish local banks, what are called the Caja, are not really in the best of health, to put it mildly. And we think it's going to cost somewhere between 10–15% of GDP to bail them out. Now, all of this is creating nervousness in the markets. There's uncertainty about the ability of the Spanish government to handle this position. And then there's the growth numbers. And the growth numbers in Spain are absolutely awful at the moment. And you've got unemployment, over 25% and 52% youth unemployment. It's getting worse and worse, and that's the problem.
And on the unemployment side of things, what's leading to what? Is it the bank problems, the debt problems, the lack of confidence is leading to that, or is it chicken and egg thing?
Well, it's a combination of the fact that the banking system isn't prepared to pass on any monetary easing. When a central bank changes monetary policy, what you need is for the normal banks to take that and pass it on to the consumers. The normal banks sit in the middle. Well, that part of the process is broken. So it doesn't matter that the ECB's interest rates are low. It doesn't help in terms of the Spanish economy. And then on top of that, we've got Chancellor Merkel of Germany crying out in this strong voice, we must have discipline, cracking the whip and demanding that the Spanish cut back on their budget deficit. And that, of course, is also a negative for economic growth. So we've got these two forces working together, and they're creating this unemployment problem in the Spanish economy.
Right, you've mentioned Angela Merkel, who I wanted to come to, or at least I wanted to come to Germany via France, because we've got this election situation in France. There is a very good chance there could be a change in leadership there, and Francois Hollande has already said he's got a few words for Angela Merkel about the way the Eurozone is going, or at least how this leadership between France and Germany is going.
Yes.
The balance, does it change? Can it potentially change there again?
No, I don't think it can change that much. I mean, I think there's a couple of things. Hollande has been making all these promises. I'm going to do this, I'm going to do that. He's a French politician. What they say and what they do are two entirely separate concepts. I'm
glad you said that.
He's not going to come in and be able to do half of what he said. He can't renegotiate the Stability Pact. It's done. It's enshrined in law. He can't renegotiate the growth mandate for the ECB because that requires 27 countries to agree. He doesn't have the power to do what he's saying he's going to do.
But just the way that France and Germany have taken the lead, we know that they have been the driving force behind everything that's happened, reactionary at least to the Eurozone problem. You change the leadership, you bring in someone who's got a lot more talk like that, surely it's got to upset the balance a little bit at the top, especially when you've got, as you say, a very strong force like Angela Merkel as well.
Well, I think what we're going to get is a frosty silence at the top, because of course Monsieur Hollande is not Angela Merkel's chosen candidate for French president. Her chosen candidate was President Sarkozy. So if Monsieur Hollande wins, then there's certainly going to be a certain froidure at the top of the European politics. But I think more importantly, the balance of power in Europe has already shifted, and it shifted earlier this year. With the French downgrade, very visibly, France has seen its influence be reduced in the Eurozone. And whereas France and Germany used to be sort of equals, two sides of the same coin, and they'd act as balancing forces to each other, I think the balance has now tilted, and France has lost political influence within the Eurozone, and Germany has gained it. So even if we do get Hollande coming in and saying, I want to do this, I want to do that, I think France's position in the Eurozone has diminished over the course of the last year or so.
What about the case of the whole Eurozone itself? You know, for a while there was all this sort of talk, a possibility of a two-tier Eurozone, put the southern countries down there where they're causing all the problems, leave them out of it and all that. Is that still crystal ball stuff, I know, but...
It's not possible, basically. We have two alternatives for the Eurozone as we go forwards. If we take a long-term view, what we have today is completely unworkable. The euro does not work. And this is not a surprise. Economists spent all of the 1990s saying the euro will not work. Economists were ignored. Bad things happen when economists are ignored. I think we can learn a lesson here. So what we've ended up with is a completely unworkable situation. Now, there are two solutions to this starting point. Either the euro breaks up. The euro breaking up would be an unmitigated disaster. You are talking military governments, you're talking potential breakup of countries, you are talking economic chaos.
And so it's not really an option, is it?
It's not really an option, although, never say never, but I think it is the absolutely horrendous scenario, and not just for Europe, for the global economy. The alternative is integration, and that I think is what we need to see. Europe must integrate more and more. We need to see the Eurozone adopt a single approach to its banking system, and we need to see the Eurozone adopt some kind of fiscal confederation over time, some kind of shared fiscal policy. Every single monetary union that has ever survived in the last 2,000 years of history has had some kind of fiscal integration alongside its monetary integration. That's where the Eurozone has got to get to.
Final thought for you then, Paul, and it's a little bit abstract, but I'm going to go with it anyway. We've invited you here. We're a business and economics show. We want to hear what you've got to say about the global economic situation. Does that reflect what happens to you in real life if you go to a gathering or something like that? Are people wanting to know if you, hey, are we going to go into recession again? Is it that bad? And I mean, are people talking about this on an everyday level?
To be honest, the question I normally get asked if I'm going out to dinner or whatever is, is now a good time to convert my money because I'm going on holiday to America next month, or what's going to happen to house prices in the United Kingdom? Because of course that's what most of my friends are most concerned about.
So that's the everyday life. That's what it comes down to for
exactly,
everyday people, isn't it? Paul Donovan, pleasure talking to you. Thank you for your time.
Thank you very much.
Finally, it's about 3 months now to the London Olympic Games, but of course in between games you have what's known as an Olympiad. That is the 4 years in which future host cities are decided. Next games up for grabs are 2020. Doha's having a crack, as are Tokyo, Baku and Madrid. And then there's Istanbul, real frontrunner actually, spurred on by a very strong Turkish economy. Joanna Gajarowska takes up that story now from Istanbul.
Şevki Aktaş has been serving street food in Istanbul's busiest square for more than 30 years. His customers have seen many political changes and financial crises. Now there's talk again of a bid for the Olympics. Şevki's experience tells him the money can be better spent.
60 or 70% of the people here in Turkey are poor. There are people who can't even afford the bread. They come and tell me I'm hungry, my child is hungry, I can't pay my electricity bill, I can't pay my rent. They are expecting me to help them. It's not just about spending money on the Olympics, it's any kind of spending. First, we must fix our house. Then, we can think about looking good for our neighbors.
But Şevki may be a voice of caution in an otherwise increasingly optimistic Turkey. Unlike many of its European neighbours, the country's economic bubble isn't about to burst. Last year, Turkey's economy grew by 8%. And after 4 failed bids, that's one of the reasons Istanbul has emerged as a frontrunner to host the 2020 Games, even though it's facing competition from Tokyo, Doha, Madrid and Baku.
This time Istanbul has a lot more to offer. Money should not be an object because we think the fact that having the Olympics in Turkey would finance itself, but if it doesn't, well, we are the fastest growing economy in Europe. We can afford to have an event like the Olympics.
But hosting an Olympics is expensive, and many previous hosts have struggled to stay afloat on their budgets. Athens and Sydney were around about twice as much as first planned. Vancouver blew its budget by more than 4 times when it hosted the Winter Games. And we don't yet know how much the London Olympics is going to cost, but it's expected to be more than 3 times what was originally planned. At the end of April, Turkey also announced it would launch a parallel bid for the 2020 European Football Championships. Critics say it could jeopardise the Olympics bid, but others think it could be a more sensible option.
Öncelikle bizim bir Avrupa Şampiyonası'nı organize etmemiz.
I think first we have to organise the European Championships, and with that experience we can organise the Olympic Games afterwards. I think it's logical. If Turkey wanted to host the Olympics, they could, but countries like ours should go step by step. Hosting the European Championships will not hit the economy as hard, and also will make a huge impression.
After 3 decades on the streets of Istanbul, Şevki can also give lessons in simple economics.
The Olympics is not a bad idea. It's very important to present our country to the world. But if we spend $100 billion and we earn only 90, we will lose. If we spend 100 billion, we have to earn at least 120.
It's an equation that politicians in Turkey could also learn from, so they won't be left trimming the fat years from now.
And that is our lot for this week. Plenty more online though. We're floating around on Twitter if you want to get in touch. Either me at Kamal AJE or our business editor at Abid Oliver Ali. Email us there too, countingthecost@aljazeera.net. Also our website, which you'll find by heading to aljazeera.com/business and linking on to the CTC page. All our episodes and our latest promo are up there for you to check out whenever you'd like. But that is it for this edition of Counting the Cost. I'm Kamal Santa Maria from the whole team. Thanks for joining us. The news on Al Jazeera is next.